Let's get more on the Australian stock market's response to this data and its outlook, and join Atul Lele, the equity strategist at Credit Suisse in Sydney. Atul, good of you to join us. So how's the market digesting all this?
Look, it is digesting it reasonably well. In terms of the performance, has been relatively sound, certainly relative to some of the overseas indices that we were seeing not only overnight but also over the last few weeks. The Australian market, of course, certainly beholden to what's happening overseas, though more so than some of the domestic developments in terms of the retail sales out yesterday and, of course, the GDP data you just mentioned.
Atul, if we look at what's happening with the equity market there in Australia, it seems it's shrugging off the good news for the Australian economy and looking at the headwinds coming out of Europe. Would that be a fair assessment?
That's an entirely fair assessment, not only out of Europe but also looking at what's coming out of China. Importantly, though, particularly with regard to what's coming out of Europe, although we are seeing credit spreads expand marginally overseas, credit spreads from a corporate perspective here in Australia, even from a sovereign perspective here in Australia, haven't really widened that much and are certainly nowhere near where they were at the crisis point around when we saw the Lehman Brothers collapse previously. So corporate credit spreads have expanded in response to what's happening in Europe, but not really as much as what we're seeing in other regions around the world.
Yeah, when we look at what's going on in terms of the equity market there in Sydney, we do, of course, have the threat of this 40% super tax on the miners. And the miners have a huge weighting, don't they?
They do, absolutely. So the miners have a 25-odd% weighting in the index, but of course there's the ancillary effects of the mining industry on the broader economy into things such as capital expenditure, all the way through into employment, which then feeds through into retail sales and the discretionary sectors. So there's a very large feed through, and there is a relative level of uncertainty that still overhangs, obviously because the resource super profits tax has not yet been brought into legislation. It's still very much being debated between the Minerals Council, the mining companies and, of course, the government.
Atul, if you were wanting to invest in Australia, is it a good time?
Look, the market is cheap. From a valuation perspective, on most of our indicators, we're 15 to 20% cheap. Both looking at the traditional indicators of things such as PE, but also looking at the relationship between real bond yields and trend earnings yield, which is our preferred valuation metric. We are undervalued right now. I think it's important to note that from a momentum perspective, we could continue to fall. Things are cheap, but they can always get cheaper, and we are certainly beholden to what's happening offshore. But right now, valuations are very, very, very attractive, not only in Australia, but we also see globally. All we are really looking for right now is just the catalyst to push the market up.
Even for those mining stocks there as well?
Absolutely. In terms of for the mining stocks, whilst the resource super profits tax is an issue that overhangs them, commodities demand more generally comes out of what's happening in terms of growth in developing markets and in terms of what's happening in liquidity around the world. Now, global growth conditions, at least for the next 3 to 6 months, are still looking quite robust. Liquidity conditions globally are still very much robust. They're the two drivers of commodity prices, less so the resource super profits tax. So resources do look attractive right now, as does energy, as does discretionary retail. So high beta sectors are the way we'd be investing in terms of being able to play a bounce in the Australian market.
What about the interest rate policy there as well? We've seen these rate hikes, haven't had one on late. We didn't have one yesterday, but do they resume, or have they done enough, the Reserve Bank?
The Reserve Bank is very much on pause at this stage, obviously concerned about the developments in Europe and what's happening globally, but mindful of the fact that the interest rate rises we've seen to date have had some impact on the Australian economy. Now, over the next calendar year, or the remainder of the calendar year rather, we are expecting interest rates to move up, in line with consensus, move up towards 5%, which would represent another 50 basis points increase. But beyond that, it remains obviously uncertain as to how strong the recovery is globally beyond the end of the calendar year. So right now we're on pause. We are expecting further rises, the timing of which remains uncertain.
Atul, thanks a lot for that. Atul Lele, an equity strategist at Credit Suisse in Sydney.